Hello everyone, and thank you all for attending this webinar on the chemical tanker market. My name is Sinthuran Raviraj, and I cover the chemical tanker market for MSI. What I would like to cover in this presentation is recent history and the current market, moving on to changes in our demand forecast and recent changes that has happened in 2020. After that, I would like to look at fleet dynamics, such as changes to supply, scrapping, and ordering, and how that affects the fundamentals. Moving on, we'll use that to see how that changes the utilization rate and our earnings outlook and price outlook. Before we look at what we forecast to happen in 2021, it is best we take a quick review on what happened in recent history and what is impacting the current market. As you can look at the chart comparing our average time charter equivalent rate versus bunker prices, you can see that spot rates have been on a downwards trend since mid-2020. Spot rates were at a high before this point. Combining with a collapse in bunker prices, this caused average TCE rates for the market to be at a high. As well known, this was also the time when product tanker demand was also at a high, reducing swing tonnage in the chemical tanker market and increasing the utilization rate in the chemical tanker sector. Since then, the surge in product tanker demand has unwounded and has been key in the fall in spot rates in key routes, as more tonnage competes for chemical cargoes. Furthermore, bunker prices have increased as oil supply-demand balances. These conditions have caused the MSI average TCE rate to fall to 12.7k per day at the start of the year. This is below most of the months seen in 2019, but remains above levels seen in 2018. With Brent crude oil now reaching $70 per barrel in March, due to supply constraints and the recent Houthi attack on a Saudi Arabian terminal, it is likely that earnings will fall even further. Chemical prices are at a high due to supply disruptions and strong demand. This will be explained further in the next slide. Chemical prices have surged in recent months, with some matching levels seen pre-pandemic and some far exceeding levels, like seen in the chart on the right-hand side of this slide, which plots styrene prices in key regions. While initially some of this could be pointed to a sign of chemical industry recovery, most of this has come from chemical supply disruptions in many regions, with the largest being in the US. Most of the key US chemical industries are situated in the US Gulf, close to cheap feedstock and energy costs, as well as ports to export cargoes. A major winter snowstorm hit the southern states between 13th to 17th of February, cutting out power, utilities, and disturbing the supply chain for key chemical plants. This still continues to heavily impact the US chemical industry, as can be seen in the chart on the left side, which plots percentage of capacity lost by chemical till 10th of March. While most of these products are not liquid chemicals, it is a clear illustration of the damage that has been done to US chemical exports. US chemical terminals were operational a few days after the storm, but as you can see, many chemical facilities are not. This should cause reduced exports in the short term. Rates remain soft out of the US due to ample space and limited cargo. Organic chemical demand contracted by 2% year-on-year in 2020, the largest fall since 2008. However, Chinese imports continued to grow and reach record levels, whereas others saw a fall in demand, as the economic effects of the pandemic were most severe in other regions. This can be seen in the chart, which illustrates organic chemical annual imports changes by region. The increase in Chinese imports came from an extra 2 million tons of methanol imports, equivalent to a 19% increase, which mainly came from a surge in Iranian methanol exports to China. With ample Iranian methanol capacity and new methanol projects planned across the world, we expect this trend to continue and be a key driver for our organic chemical trade forecast. Another positive change in the chemical tanker market was the 5% year-on-year growth in MEG trade. This was driven by an increase of 1 million tons in US MEG exports, the outcome of the recent wave in US MEG capacity. This increase in long-haul trade displaced short-haul trade from Northeast Asia to China. There was a fall in the trade of aromatics as China is building up domestic capacity, but the source of imports has gone further, increasing deadweight demand on these trade lanes. 2021 has started off at a weak spot, with many countries still under hard lockdown to control the spread of the virus. Supply disruptions in the US, as well as other regions, has reduced chemical tanker trade in Q1 this year. However, with the rollout of the vaccines and countries opening up again, we should see strong growth in trade, especially in regions outside of China. For example, the Indian economy returned to growth mode in Q4 last year and is expected to reach 10% GDP growth in 2021 to 2022 by many economists. Also, the recently approved Biden bounce, the massive stimulus program in the US, should spur the US economy this year, causing an increase in demand as well. Strong fundamentals in demand, especially in Asia, and new export-orientated chemical projects will spur trade and increase trade in the forecast. Like with the trade of organic chemicals, the trade of inorganic chemicals contracted in 2020, this time by 2.5% year-on-year. However, unlike organic chemicals, there was a contraction in global trade of each of the key inorganic chemicals. As the pandemic changed everyone's way of life, end uses for inorganic chemicals were heavily impacted as well. Key uses for these chemicals include mineral and metal processing, aluminum refining, paper manufacturing, along with many other industrial uses. In regards to caustic soda, US producers, which are the largest regional exporters, reduced operations by up to 20%, as domestic demand for its co-product chlorine dried up when construction activity was halted. This increased the caustic soda price and reduced export availability, causing US caustic soda exports to fall by 15% year-on-year in 2020. Looking at sulfuric acid, with mines in Latin America and Southeast Asia being key sources for demand, these reduced operations and thus reduced imports. This caused sulfuric acid prices to fall into the negative territory for most of 2020. Buyers in India and the US grasped at the opportunity to procure this now cheaply priced acid. Indian sulfuric acid imports went up by 27% year-on-year, equivalent to 0.5 million tons. While the US imports of sulfuric acid grew 60% year-on-year, equivalent to 0.6 million tons. This saw an increase in trade from Northeast Asia to these regions, in particular stainless steel tonnage. Phosphoric acid demand fell in 2020 due to the largest regional importer, India, closing its ports at the start of the pandemic. Monthly trade has reached pre-pandemic levels and will continue to increase this year as demand for fertilizer grows. With the vaccine program rolled out and economies opening up, we should see an increase in demand in 2021 and the remainder of the forecast. The chart looks at the quarterly trades of organic and inorganic chemicals in the last 5 years. As you can see, there has been a clear move to long-haul trade at the expense of short-haul trade in the last 2 years. As explained in the previous slides, new chemical projects in the US, Middle East, and Southeast Asia has increased long-haul trade, especially to China. There's also a shift in what chemical is acquired, as gas-based chemicals such as MEG and methanol continue to grow, but aromatic short-haul from Northeast Asia continue to fall as Chinese domestic capacity continues to grow. This shift should favour mid to large chemical tankers and reduce demand for smaller vessels that focus on the intra-Asian basin. Global edible oil trade is expected to have fallen by 3.3% year-on-year in 2020. There were large swings in palm oil trade throughout 2020, with exports at the start of the year extremely low and by mid-year were at peak levels. To a large degree, the volatility was driven by events in Malaysia, which exported only 6.1 million tons during January to May, a 24% year-on-year decline, due initially to production issues. Most years see a dip in trade at this time of year, but this was further exaggerated by low rainfall and overproduction in recent years that is thought to have reduced the yield from palm plantations in 2020. Palm oil production is labour intensive and was affected by social distancing measures, with some local governments restricted operating hours to control the spread of the virus. Malaysian plantations saw the most damage from this, as they rely heavily on migrant workers, where most returned home during the pandemic. Overall, Malaysian palm oil exports totaled 17 million tonnes in 2020, a 6% year-on-year fall. While there was a resurgence in trade at the end of 2020, palm oil prices in Q1 this year remain at over $1,000 per tonne, a high not seen in the last decade. This has dissuaded trade, causing Malaysian palm oil monthly exports to fall under 1 million tonnes in January this year. As the year progresses, production should increase from the new crop, which will cause the price to fall and trade to increase this year. The high price of palm oil in 2020 and the move to home cooking saw buyers look to sunflower and soybean oil to fulfill their needs. Soybean oil exports grew from Brazil and the US, as domestic soybean oil demand in biofuels weakened, as more people stayed at home. This saw a dramatic rise in soybean oil exports from these countries. Sunflower oil exports also saw a significant increase, especially to China and South Asia. This will be short-lived, as recent low sunflower seed production and weak weather conditions in 2020 will reduce sunflower oil trade in 2021 by 6%. This should allow soybean and palm oil imports to grow and take potential market share from sunflower oil. Moving on to chemical tanker fleet dynamics. If you look at the chart, you will see the chemical tanker order book by quarter of delivery. Since our last webinar last year, the order book has grown substantially, but is caused by large orders by a few players. Key orders include Methanex's shipping arm Waterfront ordering 650k deadweight dual fuel methanol carriers to show the viability of methanol as a marine fuel. Bari also ordered 10 50k deadweight IMO2 chemical tankers as part of its ongoing fleet expansion plans. Ordering vessels below 35k deadweight has been fairly restrained. Many owners have looked to consolidate as a way to expand their operations. European owners were the most active in this path, with key examples including Dipoli acquiring Team Tankers' European arm, adding 8 vessels to their fleet. Stolt-Nielsen combined with Esberger to create an intra-European fleet consisting of 48 vessels, the largest in the European basin. Scrapping has remained strong throughout 2020, apart from Q2, where the shipbreakers closed operations to control the spread of the virus. Overall, annual scrapping was at 0.42 million deadweight, the highest level since 2012. This is expected to continue in 2021, as high scrapping prices will push owners to scrap aged vessels. Last quarter, deliveries were low at 0.25 million deadweight, almost half the level seen in Q3 20. It looks like the first quarter of this year will see deliveries back to 0.5 million deadweight, with Jan to Feb already seeing 0.29 million deadweight of new chemical tankers, already exceeding levels seen in the last quarter of last year. There remains another 0.25 million deadweight on the order book, planned to be delivered in March this year. Turning to supply and demand fundamentals. Overall, chemical tanker demand fell by 1.6% year-on-year in 2020, the lowest level since we started recording in 1998. However, this is expected to rebound in 2021, with 6% year-on-year growth in chemical tanker demand. This will then reduce as trade normalizes and Chinese demand for certain chemicals slows. Supply growth was only 2% in 2020, the lowest in the last 5 years. This should increase to 3.2% growth by 2022, as recent waves of ordering will be delivered. Supply growth will slow after 2022 due to the restriction in contracting and an increase in scrapping, as the 20-plus-year-old fleet will reach 20% of the fleet by this year. This also will include vessels that have had their IMO classification removed and not fit for purpose to carry chemicals. Looking at earnings, you can see in the chart we are not so strong on earnings growth as we are with trade growth. A key reason for this is a weakening of the product tanker market in 2021, as seen in the second half of last year, and so far this year, time charter and spot rates remain weak, and this correlates with the fall in the product tanker market. Only stainless steel tonnage has seen some growth, with less than 1% month-on-month growth so far this year. Post-2021, we expect product tanker rates to recover as supply and demand fundamentals rebalance in that sector. and this should see swing tonnage reduce. Continual growth in the chemical tanker trade, low chemical tanker supply growth, with a positive product tanker market will all combine to drive the earning growth in the forecast. Moving on to prices. There has been an outbreak of exuberance in the new building contracting market, with all larger sectors seeing an increase in order and containers leading the pack, with orders doubling since our last update. Furthermore, shipbuildings are facing a massive cost squeeze in this quarter, as rising steel prices and the weakness of the dollar combine to devastating effect. The impact of either on its own would have been significant, but together they provide a sharp upward pressure, with 2021 average bulk newbuilding prices now assessed at 11% higher than in our Q4 20 update. This should readjust in 2022 as contracting in the wider shipping industry falls. With earnings forecasted to remain low in 2021, second-hand prices should remain in line with levels seen in 2020. So using our Horizon platform, you can create a new scenario. From here, you can select the variable that you'd like to change. I'll go with GDP growth. So you can either manually enter new sets of data, as so, or you can copy in a set of data from Excel. So I'm copying over a low case scenario for the next 5 years. So here you give it a name. Let it run. So using the Horizon platform, you can access all of our products, such as trade models, webinars, market models, and our quarterly reports. And this is all for all our sectors, not just chemical tankers. You click on compare scenarios. So I'd like to look at chemical tanker time charter rates. From here, I'd like to choose the 20k deadweight TCO. As you can see, with pessimistic growth rates for 2021 and 2022, this will heavily impact the earnings forecast for this vessel and the market as a whole. I'd like to also note that this doesn't include a supply side change. You can do this within the scenario when you are creating another scenario, but for the one I've just generated, it's just the GDP focus. Thank you all for attending this webinar. I hope you find it informative, and I hope to hear from you in the near future.